Welcome to Nasdaq TradeTalks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. We're coming to you live from Global Alts Miami by iConnections. Joining me for this segment, we have Shawn Wooden, Partner and Chief Public Pension Strategist at Apollo Asset Management. And we're here to discuss the way pensions need to think about portfolio allocation to meet their obligations. Shawn, it is great to have you with us. Welcome to Trade Talks.
Great to be with you, Jill.
All right, you got it. So, you have your experience at Apollo. You take it with being the former Connecticut State Treasurer, overseeing $50 billion in the pension system. You have a lot of deep insight into the issues that come along with managing pensions. Tell us about the challenges that's facing the U.S. pension system.
Sure. So the challenges are massive, and they've built up over decades. So looking backwards, you have significant underfunding of pension systems. In Connecticut, when I came into office, it had been prior 70 years of underfunding the system. And so you have that across the country in a lot of funds. And so you have low funded ratios. Two, you have the demographic headwinds kind of when we look forward, and I call it the silver tsunami, but the aging of Americans. Americans are living longer. For the first time in our history, we have more people over the age of 65 than under the age of 5. And so this is going to continue to put a massive strain on the pension system. If you look at trend lines, the gap today is estimated to be about 1.3 trillion between assets of pension systems and liabilities.
Right.
So those are significant.
And we're seeing that demographic across the board facing the U.S. because you don't have as many people in that younger demographic that will be working.
Well, that's exactly right, Jill.
Right.
What you see with this is, so you have more people out of the workforce and the dependency ratio is increasing. And all that means is that the amount of people currently in the workforce relative to those too young to work or those who are aged out is increasing. And so that will put an additional strain on pension systems as you have less workers paying into the system to pay out retirees that are living longer.
Right, and that's a perfect segue for my next question. So how does this impact? How do pensions need to think about their portfolio allocation, and can they just rely on your traditional equity and fixed income portfolio allocation?
The short answer is no.
Right.
The traditional 60-40 model is not going to work towards the future for a few reasons. And yesterday I did a panel on finding alpha for allocators, and this is the struggle. So you have public equities have become increasingly concentrated. Over the last 30 years, 30 years ago you had 8,000 publicly listed companies. That's down to 4,000 today. So the 400,000, excuse me. So that drop is increasing concentration.
It's nearly half.
Correct, correct. In addition to that, you really have, which we all talk about, the Magnificent Seven, and accounting for a third of, say, the S&P 500 index. And NVIDIA alone last year accounted for about a third of the gains of the S&P 500 index. So this significant concentration is really changing the game in terms of how we think about portfolio construction. You used to rely upon kind of the public markets for diversification, but now you have reduced diversification, you have the increase in index and passive investing, so you can't find alpha and outperformance, or it's much more difficult today in those public markets.
Right. Well, pensions have certain parameters and ways that they can invest. Are private markets starting to play a bigger role in the broader portfolio?
Absolutely. And you have private markets, and first of all, to define that, historically we've thought of that as venture capital, private equity, maybe hedge funds, right? It's really a much wider range, which is just alternative investments to the public markets. So you look at infrastructure, you look at private credit, so there are a range of other things. Two, the private markets are increasingly attractive because of lower volatility. You can get your diversification in there. So it's really an expanding part of an institutional investor's portfolio allocation strategy.
Yeah, and you brought up private credit, and I'm glad that you did because Apollo is a leader within that space. How is Apollo viewing that market right now? Is there any concern about it getting overcrowded or too many people using the same type of strategies? You don't want to fall back to the trap of what happened with public markets.
Sure, and I get that question a lot because there's been a lot of attention on private credit, and we obviously we do a lot in that space. And so from an Apollo perspective, when a lot of people think about private credit, they're thinking about a $1.5 trillion market, middle market, direct lending. We see a $40 trillion market with aviation, equipment financing, leasing, music royalties, but a whole suite of opportunities to invest in that sector. The other piece is it getting overcrowded? There's certainly a lot more capital coming into the space, but part of the Apollo kind of secret sauce is just not. It's not just about, we're not just purchasers of credit or from sponsors looking for someone to. We are originators. We've invested a significant amount in originating our own high quality assets. And that will be a key differentiator that will distinguish between those just in the market, investing in and trying to compete for deals versus originating your own sources, underwriting, structuring, all of those qualities. So all private capital managers are not created equal. And there's a reason why we're 500 billion plus in private credit assets alone.
All right, Shawn, appreciate the insight. Thanks for joining us on Trade Talks. And thanks for joining me from Global Alts. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.